everyone, welcome back to next episode of Mastery in Commerce. This video is in continuation to the business studies chapter of forms of business organization. In the last chapter I had taught you about cooperative societies. We had also seen what are the merits and demerits, also the types of cooperative societies. Today we are going to see joint stock companies. What are joint stock companies? See, most of the companies we look around us come under this category. Either they are private company or public company. Those are types of joint stock company that we will be seeing later. First of all, we should understand that what a company is. Company is an association of persons formed for carrying out business activities and has a legal status independent of its members. So, company is formed by its name. In the market, it is run by its name. People are not bothered who are the board of directors. People know about a company. People call a company with its own name. People don't call it by the name of its owners. Like Maruti, very common example around us. Like Tata. Okay, so many big companies, they are having their individual identity. They are not judged by the board of directors or the people who are operating them or the people who are taking care of their shares in the market. These companies generally issue shares and we common people like to invest in these companies. So all the decisions and all the power is on the board of directors, whereas there are different owners, there are different shareholders who enjoy the profit of the company. So company generally sells shares in the market with the purpose of getting some money from the people, and in return when it earns some profit, those people, according to their investment, they enjoy the profit of the company as per their investment, right? So that is a very big concept in accountancy. You will be doing this in grade 12 when you will be seeing how the books are maintained of a company, how the shareholders are given the money according to their investment. Let us now see what is a joint stock company. So as a definition you can write is an association of people formed legally. Okay, so company is under a law, it works under a law and it has independent identity. So there is management to take care of the day-to-day working, but the company has its own individual identity. Now we come on to first of all also see that it is formed by Companies Act 2013. Formed by Companies Act 2013. So all the regulations which are there according to this Companies Act, the company has to follow it. Now what are the features of joint stock company? The features of joint stock company are, it is an artificial person. Why artificial person? Because whatever dealings are done by the company, it is on its own name. It is treated like a different person, but the person who cannot breathe, smile, eat. So it is an artificial person. It has its own identity. It is called by its name as people are called. It works in the market by its own name. It runs its business, it earns profit, if loss is there, it suffers from loss also. So everything is like an individual. Second is separate legal entity. Separate legal entity, why? Because company has its own status in the market. It is different from its members. Then formation, there are certain rules and regulations to be followed. All the legal formalities have to be done. Then only company can be formed. The next is perpetual succession. Very important, please mark with you, because it is often told that explain this feature of a company, which means perpetual succession. Means it is created by law and it can end only by law. Please write it in bracket so that you remember what it means. Members may come and go, but company goes on forever. It has own succeeding life, full life it has, but it can be created by law and only and by law. Legal formalities have to be completed. Then control of a company is on board of directors. Board of directors keep complete control on the management. Next is liability. So the liability of members is limited, but company's liability is unlimited. So if a person is has given loan to the company, then that person is not getting the money back, so he can take the personal assets of the company, not the members. Okay, so these liability of members is limited, so they enjoy the limited liability. Then there is common seal. Company has no signature of its own. Whatever documents are being signed or whatever documents are being prepared, the signature of the company is the seal. So every company should have a seal. Risk bearing. So the risk bearing is jointly done. The people who are taking care of if there is any kind of loss, then shareholders also have to bear the loss, because the value of the shares goes down in the market. All the shareholders actually bear the risk. So generally we as a public, we invest in the companies which are having higher profits. Now next is merits of joint stock company. So what are the merits? The first thing is members have limited liability. Obviously when members have limited liability, they will not be in a risk of someone taking their assets. Then second is transfer of interest. Transfer of interest is a new thing for you. Please write this in your bracket, in your notebook. Transfer of interest means shares can be sold whenever cash is required. So shares can be converted to cash. That is transfer of interest. I can sell my share in the market whenever I need cash. Now the perpetual existence, which is also its feature, is its advantage. Perpetual existence because it cannot end because of end of its members. Then scope for expansion. There is lots of scope for expansion. We all know companies issue their shares. Suppose I want to expand my business, I have my own company, so I can issue more shares in the market and get the capital. So it is easy for me to get the capital whenever I want. I can even take the loan from financial institutions and the banks whenever I need for my company, because companies are registered and banks and financial institutions are not at risk in giving the loans. So they very happily give the loan to the company if the company is running in profit. Right? So whenever I want to expand my business, I have good scope, I have chance to get more of capital. Then professional management. Obviously the management which is appointed by a company is well qualified, and management is capable to make the decisions which are profitable for the company, which are good for the company. Now we go to the limitations. Limitations of the company are, first of all, complexity in formation. Why complexity? Because lots of legal formalities have to be done whenever you are planning to start a company. You have to prepare lots of documents. Then lack of secrecy. Why lack of secrecy? Because there are different people who are involved in the working of the company. If you want to keep anything secret, it is not possible. They all have full right to know what is being done in the management, and it generally goes public also. So you might be knowing that many big companies, news come in is very quickly in the market. If any company is in loss, any company is going to be bankrupt, or any company is multi-millionaire, so those all things quickly come in the news. Why? Because they are not able to keep that much of secret. Then impersonal work environment. Why impersonal work environment? Because there are many members in the company, where sometimes you find it very difficult to have the personal work environment. Many people are involved, they may be outsiders, they are coming and going, marketing team different, HR team different, so many people are involved in a company. Then there are numerous regulations. Why numerous regulations? Because company has to be registered, so everyone is keeping an eye on it. You have to get the audits done. Then for every decision there has to be voting done, right? Then you have to file the reports. Lots of reports have to be filed. Then when you have shares, then SEBI also interferes, right? SEBI, it controls the shareholding market. Then registrar also keeps an eye on your working. So lots of things have to be taken care of whenever you are running a joint stock company. Sometimes there is delay in decision making because there are different levels of management, lower management, middle management, higher management. So one decision takes long time to be taken. If one owner is there, he can quickly take the decision. If one management team is there, quickly decision can be taken. But when there are different levels of decision taking, then it is always delayed. Then is oligarchic management. What does it mean? That shareholders are a part of management, right? When you are investing money, then you are a shareholder. But shareholders cannot be present in the meetings, right? Now I am investing in a company, I cannot go for the meeting. So board of directors, board of directors enjoy decision taking. So what happens, maybe their decisions are in their own favor rather than thinking about the shareholders. So shareholders are not able to participate in the management according to their investment. Then there is, we all know, whenever lots of people are involved, everyone will think of their own interest. They will not be thinking of the interest of the company. Like if I ask from a consumer wants things at a cheaper price. If I ask the employee, then employee wants higher salary, right? So he will think about himself, why he will think about the consumer. Then if I ask the shareholders, then shareholders want more part in profit. So everyone, when these all so many people are involved, and board of directors have their own thought, then the other people, the people, financial institutions who have given loan to the company have their own interest. So everyone has different way of analyzing and understanding the things. So it results in conflict. The consumer may not agree with the employee may not agree with shareholder may not agree with the consumer. So many things are there which are resulting in the clashes between the people in the joint stock company. So these are the limitations, these are the merits. In exam, if you get the difference between different forms of business organizations, then these are going to help you to explain the difference, right? In the next class, we will be doing the difference between private company and public company, and then this chapter will be over. Now in this chapter, lots of case study questions can be asked in exam. So please take care of it, that you prepare each point. That is why these points ready, recon you have with you. While I am taking the video, you can write down in your notebook and try to understand what each point means. It is going to make the topic simplified for you. I hope you like this video. Please like, share and subscribe my channel. I will be grateful because your subscription motivates me. In the next video, we'll finish the chapter. Please go through the previous videos so that you understand each type of business organization. We will meet again in the next video. Bye for now.